Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tactile Systems Technology Inc. Annual Report. Tactile Systems Technology Inc. offers a range of medical devices and services to treat chronic diseases in the United States. The company's product line includes FlexiTouch Plus system for treating lymphedema, phlebolymphedema, lipedema, venous insufficiencies, and other types of edema and leg ulcers. In addition to FlexiTouch Plus, Tactile Systems Technology also provides Intre Plus system, a pneumatic compression device for at-home treatment of lymphedema, chronic edema, venous insufficiency, and chronic wounds. The company's Nimble platform is designed for the treatment of upper extremity lymphedema. The company's services extend beyond medical devices to include digital solutions such as Kylie, a mobile application that helps patients learn about lymphedema, track their symptoms, and share progress with their doctor. Tactile Systems Technology also offers a Flow Vest, a portable high-frequency chest wall oscillation vest for treating patients with retained pulmonary secretions resulting from bronchiectasis, cystic fibrosis, and various neuromuscular disorders. Overall, the company's product line and services cater to individuals suffering from chronic diseases such as lymphedema, venous insufficiencies, and other types of edema. The stock price of Tactile Systems Technology Inc. (TCMD) has skyrocketed by 114.89% in the past year, driven by a series of positive news events. The company's robust fourth quarter and full year 2025 financial results were a major catalyst for this surge. With diluted earnings per share exceeding consensus estimates and revenue reaching $103.6 million, surpassing analyst expectations, Tactile Systems Technology demonstrated its strong performance in the market. The company's management also issued bullish guidance for fiscal year 2026, projecting revenue between $357 million and $365 million, and adjusted EBITDA between $49 million and $51 million. This upgrade in guidance further boosted investor confidence in the company's growth prospects. Additionally, Tactile Systems Technology made a strategic acquisition of LymphaTech, enhancing its capabilities in lymphedema treatment. Several financial analysts reacted positively to these developments, upgrading their price targets for TCMD stock. The publication of clinical evidence supporting the product's effectiveness also contributed to the positive sentiment around the company. Furthermore, the company's engagement in stock repurchases added to shareholder returns, creating a strong positive sentiment that drove its stock price significantly higher in the past year. Tactile Systems Technology, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Tactile Systems Technology, Inc. trades at a higher price-to-earnings ratio of 43 times and a higher price-to-book ratio of 3.39 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 27% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On one hand, the sales and rentals of lymphedema products have been a significant contributor to revenue growth, with an 8% increase in 2025 compared to the previous year. Additionally, the airway clearance product line has seen a substantial surge in sales, with a 52% increase in 2025. On the other hand, changes in payment terms with commercial insurers and the Veterans Administration have had a negative impact on revenue growth. The decrease in private insurer and other payers' revenue by $6.5 million, 4%, from 2024 to 2025, is a notable decline driver. Furthermore, the reduction in Veterans Administration revenue by $1.9 million, 6%, from 2024 to 2025, also contributed to the decline. However, it's worth noting that Medicare sales with extended payment terms have been a significant growth driver, increasing by $27.4 million, 52%, from 2023 to 2025. Overall, the main drivers of revenue growth or decline are closely tied to changes in product sales and rental volumes, as well as shifts in payment terms with various payers. Net income experienced significant fluctuations between 2023 and 2025. Initially, it increased from an unknown amount to $19.1 million. However, this growth was short-lived as net income decreased due to increased expenses related to developing new products. Furthermore, a decline of 33% in net income was observed between 2023 and 2025. Despite this, the net income saw a significant increase by $2,126 million, minus 13%, to $19,086 million in 2025. Profit margins also underwent changes during this period. Due to the lack of previous year's data, profit margins were not comparable at first. Nevertheless, they may have decreased due to lower prices resulting from increased competition among payers and alliances. Additionally, diverting management's attention away from existing business led to a decline in profit margins. The reasons behind these changes are multifaceted. Increased costs from trade tariffs and restrictions, decreased reimbursement rates, and higher labor costs all contributed to the fluctuations in net income and profit margins. Furthermore, lower prices resulting from increased competition among payers and alliances also had an impact on profit margins. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from 2023 to 2025 shows an increase in operating cash flow, with amounts ranging from $35,855 in 2023 to $42,811,000 in 2025. This upward trajectory suggests that the company is efficiently managing its operations and generating sufficient cash to cover its expenses. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over the past year. Initially, the original term loan stood at $24.4 million, while the revolving credit facility increased from $25 million to $40 million. However, as of December 31, 2025, there were no outstanding borrowings under this facility. Furthermore, the term loan was paid off in full on July 31, 2025, resulting in a substantial reduction in debt. In terms of interest expenses, the company has experienced a significant decrease. The interest expense decreased by $1,047,000, minus 50%, from 2024 to 2025, indicating a substantial reduction in costs. This decline is attributed to various factors, including the elimination of temporary covenant relief period and changes to the revolving credit facility. Overall, these changes suggest that the company has made efforts to manage its debt and reduce interest expenses. Management is optimistic about the company's future prospects, driven by increased awareness of lymphedema and its products. However, they acknowledge potential challenges, such as pricing pressure from private insurers and seasonality in revenue. To mitigate these risks, the company has implemented a share repurchase program to boost shareholder value. In terms of strategy, management plans to drive revenue growth through expansion of its commercial infrastructure. This will involve investing in research and development (R&D) to enhance and commercialize new products. While R&D expenses are expected to increase, management believes that this investment will yield long-term benefits for the company. Overall, management's outlook is focused on driving growth while managing risks associated with regulatory changes, product liability claims, cybersecurity threats, and inflation. By investing in its commercial infrastructure and R&D, the company aims to maintain a strong financial position and deliver value to shareholders. The company has made several key acquisitions and divestitures over the years. In terms of acquisitions, two notable transactions stand out. The first was the acquisition of the Flow Vest business in September 2021, which marked a significant expansion for the company. Additionally, the company acquired certain assets related to the Flow Vest airway clearance product line on September 8, 2021. In terms of divestitures, there were no notable transactions mentioned until page 118 of the report. However, it was noted that the earn-out arrangements related to the Flow Vest acquisition had been paid in full as of December 31, 2023. This suggests that while the company may not have made any major divestitures, it has completed its obligations related to previous acquisitions. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends to its investors. Specifically, the company has paid out cumulative accrued dividends of $8.2 million to Series A convertible preferred stockholders. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. The company's financial reports confirm that it has engaged in multiple rounds of share repurchases across various pages, including page 72, 84, 85, and 109. This demonstrates a commitment to maximizing shareholder value by reducing the number of outstanding shares on the market. There are valid concerns about inventory buildup and supply chain disruption. The potential for supply disruption is a pressing issue due to the inability to find replacement suppliers and insufficient product inventories. This vulnerability is further exacerbated by trade policies that impact raw material costs and availability. The lack of redundant facilities and limited inventory of reserve raw materials and finished products also pose significant risks to the supply chain. Furthermore, an increase in in-transit inventory from $1,013,000 in 2024 to $1,931,000 in 2025 suggests a buildup of stock that may not be readily available for production or sale. These factors collectively indicate a potential for supply chain disruption and highlight the need for companies to reassess their inventory management strategies and supplier relationships. That concludes the financial summary for Tactile Systems Technology Inc. Feel free to comment below, and I will be happy to answer them when possible.